financial performance in Q2 and H1 of the year. To you, Abdurrahman.
Thank you, Hatem. Assalamu alaikum and good afternoon, everyone. Before we deep dive into the financial performance of Q2, it's always a great opportunity to reflect in the history of Bupa. Bupa Arabia has been operational for the last 25 years. Today we are more than 2,000 employees, serving more than 3.8 million lives through our tremendous network of providers, which exceed 1,400. Looking at the trend since the company went IPO in 2008, we started our top line with merely 871 million. Fast forward all the way to 2024, we're able to close the year with 18.4 billion, which represents a CAGR that well exceeds the sector of 10%. We're able to actually achieve 16%. That story continued in the first half of 2020. We were able to actually achieve a GWP of 12 billion, which represents a 10% growth from the previous year. Now that growth came in both price increases through the inflation we've seen in the last few years, but also a considerable growth in the insured lives, to the point where we've achieved our all-time high insured lives as of June of 2025. We're able to actually grow our insured lives by roughly 7.5%, comparing the first half of 2025 and the first half of 2024. Looking at the historical profitability, we're always proud on the fact that Bupa Arabia is the only consistently profitable company in the sector, despite the volatility of the sector in certain years. We've been profitable ever since we went public, with 2023, our first year, exceeding the 1 billion mark, which moved to 2024. For the first half of 2025, it's been a challenging half for the sector, and we will deep dive into that in the upcoming slides. The stock price is another successful story where the stock of Bupa Arabia, looking at the lifetime performance, is one of the best performing stock in the Tadawul Stock Exchange. Now, moving ahead to our 3B strategy, which we launched in 2024. And the strategy is centered around our ambition to transform Bupa Arabia from an insurance company to become a healthcare company by 2030. And our strategic pathways to achieve that ambition is focused around boosting the core, which is the insurance, looking at our customer value proposition, improving our reachability, and sustaining our leadership. Bending the curve looks at the rising medical inflation, which we've seen post-COVID, moving into the double-digit level year on year. So how can we focus on introducing the right initiatives and partnerships and leveraging data to be able to actually bend the inflation curve? Third is beyond PMI, which is our ambition to expand into vertical integration and explore other opportunities in the same space. Now, looking more specifically into the performance of Q2. Now, we've seen a top line growth of 2% on the insurance revenue, and that's on an earning basis. As I've mentioned in the earlier slide, we have seen a significant growth in our GWP by 10% on the first half of the year, but the majority of that growth came on the latter half of the second quarter, and that will translate into insurance revenue growth on an earning basis over the upcoming 12 months. Now, looking at the insurance service results, we actually have witnessed a 17% drop in the insurance service results, and that was primarily driven by higher than expected inflation, which is actually due to a change in behavior we've seen in our higher network clients, where we've seen that their behavior have shifted claims towards the higher end providers, which definitely impacted our profitability in the quarter. Now, that change in behavior we've immediately reflected in our pricing methodology to ensure that that is priced in for future contracts, and we're currently introducing the right intervention to try to mitigate that behavior in the second half of the year. Now, typically, since Bupa is exposed, or the client mix in Bupa Arabia is tilted towards the higher end of the spectrum when it comes to networks, we expect that impact to be higher than the market when it comes to our performance in our inflation. Now, looking at investment income, that continues to grow, where we're able to achieve 371 million, which represents a 9% growth from the first half of 2024. All of that led to the drop in the earnings before tax by 12% to reach to the 776 million for the first half of 2025. Moving ahead to the bridge between the first half of 2024 to 2025 in the upcoming slide, where, again, as explained, the majority of the drop in the profitability is actually driven by the change in insurance revenue or the insurance results, which is a factor of the inflationary trends that we have seen increasing in the second quarter for the year. Now, I'll pass it to Ahmed Bagnet to take us through the investment portfolio and the results. Over to you, Ahmed. I think, Ahmed, you're muted. I think Ahmed is just facing a technical issue. Hatem, do you want to step in?
Yeah, Ahmed is joining me here to give you an update on the investment income for the second quarter.
Thank you, everyone. And apologies for this. I had issues with the mic. As far as the investment income results, as Abdulrahman mentioned, we've registered above 370 million of investment income for the first half of the year. Alhamdulillah, driven by still relatively elevated level of interest rates, despite obviously the drop. So we've maintained resilient investment income for the period. In addition to also a support from the increase in the size of the portfolio, as you see from the first half of 2024 to the period of 2025, by an addition of roughly 700 million. And we continue to drive diversification of the portfolio and enhance the duration of the book by reallocating from the deposits to the sukuk. As you see in the middle chart, the allocation to deposits have dropped from 53% to 46%, a significant drop at the expense of the sukuk portfolio. So we continue to see favorable investment income, and happy to answer any questions at the end of the call. Back to you, Abdulrahman.
Thank you, Ahmed. Now, moving ahead to a bit of insights on the market share and the positioning. Bupa continues to be the market leader as of the first half of 2025, both on an overall basis as well as on the health insurance market, with 28.3% on the overall sector. And looking more specifically at the health insurance market share, we're currently sitting at 46%, which is quite similar to the first half of last year. Now, moving ahead to the performance of the overall sector. Despite the growth that we see in the overall insurance market, insurance revenue by 7.5%, we've seen a significant deterioration in the profitability of the sector, where there is a drop of 36% in the earnings before tax for the entire sector. And that's primarily driven by the deterioration in the insurance service results, which, again, is a factor of multiple lines of business, but primarily the motor line of business, given that that's the biggest exposure in the sector. Now, moving ahead to the health insurance market. we can see that the insurance revenue on an overall basis has actually grown by 10%, while insurance service results are actually improved as well by 21%. And with that, the insurance results margin have improved as well. It's worth mentioning that beyond the top two players, most of the sector in the health insurance space are actually loss-making in the first half of last year. And we see most of them improving, but still the majority of which are still loss-making or barely breaking the profitability line. And that improvement in the lesser losses that we have seen in those clients have actually resulted in the overall sector improving. Now, lastly, looking at the GWB segmentation, Bupa continues to be the market leader on the corporate space as well as the higher end of the SME, where the majority of the sector is actually tilted, while the other lines of business will remain consistent with prior years. With that, I'll hand it over to Ali Schneimer to take us through the market updates.
Thank you, Abdurrahman. Is my voice clear?
Yes, Ali.
The health insured lives have actually progressed well and have grown almost 11% compared to the first half of last year. This was entirely driven by considerable growth in the job creation in the Saudi market. In fact, during Q2, Saudi job market recorded an all-time high figure of 13.1 million employees in the private sector. This is 2 million jobs created over the last 12 months, which is a reflection of the robustness of the Saudi economy. And we expect this to continue during the coming quarters. So most of the growth was driven by the growth of the job market. Growth was universal across different segments, whether Saudis and non-Saudis. And of course, when you have job creation that pours into the insurance market, with it comes the dependents, which we see them also growing for both Saudis and expats. On the second slide, this is just showing the historical progress of the insured lives. The top of the slide is the Saudis, and then you have the expats. And you can see that expats are actually outgrowing in terms of, in the growth in the insured lives. They have grown almost close to 13% versus Saudis around 7%, which is logical given that most of the expats are in the blue collar segments, driven by huge growth in the construction business, whether in the private sector or the government projects. The gap remains, and I know this is a concern for everyone in the sector. With the job creation that we see, the gap remains high, almost 32% for Saudis and 23% for expats. That's a huge loss opportunity for the sector. You're talking about more than 3 million employees today without insurance. If you factor in the dependents, you talk about 4.5 million. If you take the average premium of 2024 per life, you're talking about 13 to 14 billion riyals worth of premium that today sits outside the insurance market. The sector, through the different committees structured under the regulators, are always pressing this as an issue with the regulators to get the enforcement gap to start reversing and closing down, whether with CHI or insurance authority, but it remains significant. That's on the insured lives. Probably Nasser will take us through the challenges and the inflation trends in the sector.
Thank you, Ali. Assalamu alaikum and good evening, everyone. This is to update you about the inflation outlook. As we progress in 25, we have updated the market inflation estimate from 8.2% to 10.6%. The 2.4% increase is driven mainly by two factors. First, higher number of claimants accessing care than usual, mainly due to an increase in awareness and easier accessibility to providers. And second, a noticeable shift in claimant behavior, with more claimant and members choosing higher cost providers. It's important to highlight that this trend is not unique to Bupa, but also aligns with the broader market dynamics. The latest global medical trend report by ION that was issued in 2025 estimated inflation at 10%, also supported by the announced result of the publicly listed providers during H1. While inflationary pressure remains a challenge, our proactive measures in provider partnerships, product design, care management, as well as digital engagement are helping the claim base to be controlled while ensuring quality outcomes for our members. That's all in terms of inflation. I'll leave it now to Med for Care Connect update.
Elena, I think Med needs to be unmuted.
Sure, I will request him to unmute his microphone, but he should be able to.
Yeah, Med, we
I
can
think
hear.
he's on now. Yes.
Hello?
Yes, we can hear you, Med. Yes, we can hear you.
Oh, excellent. Let me just start with a refresher about the Bupa Care Connect offering. So basically, what Bupa Care Connect is the provision arm of Bupa Arabia. Bupa Arabia launched Bupa Care Connect in January 2024. So we have roughly around 16 months of existence. We try to provide a proactive healthcare that is mainly focused on prevention, well-being, and digital first engagement. The Bupa Care Connect main core offering is a holistic approach that puts the member health at the center, but to mainly handle the end-to-end health needs of the member through a set of service offering. These offerings varies between digital offering, supporting services, and in-person care, as well as handling the health experience and the health outcome of Bupa Arabia member inside the hospitals of belonging to our network of providers that we work with them as a payers. The main outcomes we're targeting from offering what we call the connected care model is three major outcomes: a better medical spend, and improved medical outcomes, and a higher experience for our members. The services we offer, and before I deep dive in these services, I want to reiterate that we're trying to build a healthcare ecosystem for Bupa Arabia members that is as comprehensive as possible. This healthcare ecosystem, some of the services are under the management and the control and the operations of Bupa Care Connect and Bupa Arabia, and others also are not are done. Let me say are done in partnership with strategic partners. We, in terms of provision, the way we're tackling it is that we're not gonna offer everything ourselves. However, we'll strategically partner with a few selected key stakeholders who will be part of our ecosystem, whether in terms of digital care or supporting services or in-person care or referral management. Few of the services, just an example of what we offer, part of this health ecosystem that we've been building the past few years, even before we venture in the healthcare provision, include virtual consultation, e-prescription, medication delivery and refill, a lab, home healthcare, in-house clinic at the customer sites, which we call corporate health centers, as well as managing and trying to control all of the pain points inside the hospitals, the partner hospitals. But some of the services started 10 years ago, and we were doing them through our strategic partners, such as medication delivery and refill. And now some of these services have moved to be delivered directly by Bupa Care Connect, and the rest stayed with the selected strategic partners. If you can go to the next slide. The approach, the following slide summarizes the approach of the connected care model. Our book is segmented into three major groups: high risk, severely ill, or let's say mainly chronic patient, a normal sickness, and the generally healthy. And for each of these segments and each of these groups, we have a different mode of engagement and a different pathways and different teams who approach them with a clear outcomes in mind. And these outcomes are linked to the strategic outcome I talked about in the first slide, which is the medical spend, the superior experience, and the health outcome. Some of these services is, as you can see in the right hand side of the slide, which is having a medical health navigator assigned to each of the members who are enrolled in the different programs we offer to our members. We have also on-site care in the different medical facilities. We have clinical excellence and medical case managers who collaborate day in and day out and collaborate in a close partnership with the treating doctors inside all of the strategic hospitals, or we partner with to discuss treatment plan and to manage the case the moment the patient is admitted until his discharge. We have a continuity of care doctors who also manage the health of the member post-discharge and continue the care with them even after their discharge from the hospital to ensure to avoid readmission. I'm not going to go into the details of all of these services, but for the way we approach it is that we manage the health risks of our member by having a very proactive, engaging approach that deals with the different category in a different way. We have a very customized healthcare pathways for each group, and we've designed a bunch of services for each of these categories. And the teams, whether it's doctors or nurses or professionals or nutritionist or well-being expert are engaging these members depending on the segment they're in. Next slide, please. Just a few quick numbers that describes or give an idea about the progress we had in the first half of 2025. Bupa Care Connect delivered roughly around 200,000 transactions to its member with engagement that include basically 220 teleconsultation. We're targeting this year to have roughly around 390,000 consultation, and we've delivered around 100,000 medication requests. We've delivered around 50,000 home-based lab. We've beefed up our clinical team about around 50 doctors, and here we're talking about the clinical doctors who deliver those telehealth consultation and the e-prescription. Those are licensed doctors with Saudi Health Council. The extended team of Bupa Care Connect is more than 400 healthcare professionals that include other doctors who are not clinical excellence doctors, but they have a different job in terms of care navigation, in terms of managing the cases inside the partner hospitals. We continue to invest in expanding the clinical team, and next year we're planning to increase the number of clinical doctors and scale all of these services. Next slide, please. Now to the exciting stuff. So we've been beefing up our connected care model and our value proposition by a lot of the services, the supporting services, in terms of ancillary services and in terms of extended offering that help serve the members at their home. However, back in mid 2024, we realized that we want to go downstream and offer also services at an important touch point, which is the physical outpatient and the primary care. We're proud to announce that in Q4 2025, we will be opening our flagship multidisciplinary clinic in Riyadh. This will be the first primary care clinic that will complement our digital offering. It's 4,600 square meter clinic with more than 15 specialties, with 30 clinics, 30 exam rooms, and 120 staff, from nurses to consultant to GPs, and it will also include a full MRI, CT scan, radiology centers, and we think it's going to make a massive difference into our value proposition and health spend management in the Riyadh region. These will be our flagship. It's going to ensure that the digital offering is synchronized with the physical offering, and it will target the groups that I mentioned in the health risk pyramid. And it will be the first clinic. It's not the typical clinic or a small clinic targeting the basic specialties such as family medicine or internal medicine like competition. However, it will be a comprehensive one-stop shop, because we came to the conclusion that in the kingdom, members do not want to have the services fragmented between several centers and labs, and they want to get all of the services in the same center, especially for the highest segment of the health risk pyramid, the chronic patients and the high risk members. After that, since it's a flagship, it's taken about a year, because we want to get it right. It's a smart clinic where the digital offering is present everywhere. It's a continuity of the digital offering where members who will be referred to the clinic will have everything ready before they come, their health record, everything that all of the interaction that has happened with the Bupa Care Connect prior to them coming to that clinic. It will be known to the doctors, to the health professionals, to the service staff from the valet till the admin, till all of the staff, to make that experience very smooth and allow the doctor to focus on moving the needle as far as the health outcome is concerned. After that, it's going to be we will roll out to the second clinic in Riyadh as well. We're targeting to open the second clinic in Riyadh in 2026. Our plan is to open 7 of these clinics, and they will allow us to complete our connected care value proposition and allow a comprehensive in-person care for our members. This clinic will go live in Q4 2025. We are in the last 100 meters. We're working closely with the regulator to secure all of the licenses. And once it's open, then the rollout will go fast for the rest of the clinics, because all of the design will be locked, all of the standard operating procedures, the resourcing will be standardized, and it will be only a matter of rolling out to the rest of the kingdom. But the second clinic, similar setup, will open also in Riyadh in around Q2 2026. We're working in parallel on other regions as well, and we'll announce the launch of these clinics in a due time. Next. Yeah, I think with that slide, I've concluded the section related to Bupa Care Connect.
Thank you, Med. I will jump in. There is echo in the system. These are just quick highlights. We'll share just the new ones. Previous ones probably have seen them in previous webcasts or have been announced on the Tadawul. We have, as you noticed, over the past couple of months, we have launched and we expanded our network of no pre-authorization providers. We have partnered with almost 17 leading providers across the 3 regions to offer our customers an experience that is unmatched. No pre-authorization is required at these providers. We have seen a great surge in the Net Promoter Score of the members who have been to these providers. You go there, easy in and out. You don't have to wait for pre-authorization to be sent to the insurance company and replied to. We target to have around 20 providers by end of this year across the 3 regions, with majority of them will be in Riyadh, given the size of the business in there. The rest of the highlights, probably you have seen them already announced, so I'll not go through them. Again, on the reforms that's taking place within the sector, the newsworthy piece of information here is that Insurance Authority and Capital Market Authority have signed a cooperation agreement to align the oversight of listed insurers to have consistent regulations to advance towards the Vision 2030, which is good for the sector. The other thing is starting 2025, Human Resources and Social Development in partnership with MOH implemented the first phase of Saadization in the healthcare sector, and probably we'll see more. during the year. So they are targeting certain jobs within the healthcare sector to be fully Saudized. This is the brag sheet that we share. We feel always proud of being recognized, and we believe this is the outcome of doing the right thing for our members and for the business. And to utilize the rest of the time, probably it's best to go for the Q&A. I'm sure we have almost 180 person attending with us today, and you have lots of questions. So let's get to that right away.
Thank you very much for the presentation. We'll move now to the Q&A. If you have a question, you can write it in the chat, or you can also click on the raise hand button and I will unmute your microphone. If I can also ask participants to state their company name before asking their questions to management. We'll take the first question now from Abdallah Al-Buraidi. Please go ahead.
Am I audible? Hello?
Yes, you are. Please go ahead.
Yeah, thank you very much for the great presentation. Good afternoon. Regarding what you've mentioned on the increased loss ratio that we are seeing at the top two, but not on the rest, and that coming from a behavior of higher classes moving to higher hospitals. I want to understand what motivates those higher classes going to higher prices provider compared to before, and why do you see this impacting Bupa more than the rest? Moreover, we noticed the GWP growth has been quite handsome. However, we see the onerous provision contract for the first quarter and the second quarter being recorded unlike last year. So this might indicate that you've been aggressive on pricing and some of the contract became loss-making and hence recorded on onerous contracts. Correct me if I'm wrong, and if you can elaborate on this.
Thank you, Abdullah, for the question, and allow me to correct some points regarding the first part. What we were highlighting is that we are noticing a shift in inflation due to concentration at high unit cost providers, and it impacts different insurance companies differently, given the constitution of the book. So if you have a higher concentration at high end products, you are impacted more. So that concentration at high unit cost providers is witnessed first in the public report that was mentioning inflation reaching 10%. Second, you can see it with the publicly listed providers announcing their average growth of top line of 22%. So this is where you can complement the information on the growth on the higher unit cost. And then and your second point is regarding the onerous contract. It's actually not necessarily you intentionally priced contracts lower, but if the catch-up of inflation and the growth of inflation is higher than the prices of the contract, that turns into writing a contract that is becoming onerous. So not necessarily in Bupa, as you know, we are the only company that has been consistently profitable. We never write contracts that are loss-making. And actually, whatever we report under onerous contract also takes into consideration a contingency margin on the risk level. So without that, actually, we are at a healthy level, but we are being extra prudent on the projections in the coming period. Hence, you see the onerous contract being written in quarter two.
Okay.
Nasser, if I missed any other point, please feel free to jump in.
Thank you very much for your comment. You sum it up very well. Also, there is a factor of seasonality. So you even if you go back to 24, 23, you would always rely on the remaining seasonality of the year to calculate your inflation, to basically to match your revenue with the claims. This is a major factor given the change in seasonality behavior this year. So this should be taken into account when you assess the honesty, the reported honesty.
Yeah, but if we look for the first half, just to ignore the seasonality, we notice the combined ratio, which we can calculate on the financials, not the accurate one, increased by 1.4%. And just on that, so you've mentioned that you've adjusted your prices to reflect the behavioral change. So would you expect second half to be better seasonally than second half last year, and hence ending up the year in a much closer footing to last year?
Look, Abdullah, I'll not comment on the expectation on half two, but let me give you a proxy on how I think you could make that assessment. So, as mentioned, we already took measures to protect the health of the book, but there was the concentration driving the inflation ahead of the price increase that was taken in the previous period. But that has already been corrected. However, if you go back to 2021, you would actually see a similar trend where first half of the year inflation was growing ahead of price increase, and after the correction that balanced out in half two, and then for 2 years in a row we've been pricing that inflation and improving the margin as we go. So that's part of the cycle that we are going through right now, which is a normal cycle that happens every couple of years. And I mean, that those measures are already taken. The results of the coming quarter would show whether that was enough to mitigate that risk or not.
Thank you very much, Wafiqkum.
No problem. Thank you, Abdullah.
We will take the next question now from Shiro Ghosh. Please go ahead.
Hi, I'm Chiro Ghosh from SICO Bahrain. So I have a few questions. The first one is I want to get a better sense on the competitive landscape. I mean, purely from the pricing point of view. So when we heard the conference call from your direct rival, they are saying that they are able to capture new big clients. So just want to get your sense or thoughts on what is the competitive landscape, how is the pricing pressure from this direct rival and the relatively smaller ones. That's my first question. Second one is I saw the investment portfolio is moving towards slightly longer duration. So so you're technically better placed than maybe the smaller players. So would it give you a better pricing power once the interest rate cycle comes down? That would be my second question. And third one, very quickly, from Bupa Care's perspective, what would be your longer term budget or what kind of earnings are you expecting from that? Yeah, these are my questions.
Okay, so allow me to take the first one, and then I'll move the third one and move to Ahmed Bajnet. So on the competitive landscape, the market is still quite competitive. You see growth for Bupa and for the main competitor as well. However, based on our assessment of the market, the bigger impact is coming from inflation. If you recall, last year we had a reduction in inflation versus the year before, and even the year before that. So we had 2 years of an inflation that is not back to normal, to pre-COVID era, but it was dropping year on year. This year we are seeing the trend going the other way around due to the concentration at the higher unit cost provider, which I mentioned earlier. So based on our assessment of the market, this is the bigger impact, but the market is still quite competitive when it comes to market share. However, even with that, the inflation hit is the main driver dropping the net insurance results. Now, on the third point, I think Med gave a comprehensive view on our expectation on what we want to to achieve. And I mean, on the projection for the future, again, I will not be sharing projections, but just to give you the overall aspiration is to drive a better health outcome and a better experience for our members. So we are targeting to serve more members, as you saw in the slide, which is available for you after the presentation. You can have a look at it as well. Is we're already reaching a good level of penetration and reach for our members, and we are aiming to help them have a better experience and a better health outcome. Thank you. So I'll move to Ahmed, unless Aruna, you have any other clarification on those points.
Oh, I think on the investment book, yes, we've been extending the duration. So yes, the investment income should be stable with interest rates coming down. I think, Hatem, the question is how is this going to impact the pricing environment, which for us, we continue to price accounts to be profitable. But maybe Hatem, I think that was the question, more on the price.
Yeah, in terms of pricing, so as Ahmed said, we are already locking a longer term portfolio, but I mean, the way we price, we assess the risk on its own, regardless of the portfolio. Every account needs to be financially sustainable, and there is an echo, Elena. Can you hear me?
Yes, we can hear you.
Okay, so I was just saying that we are targeting a healthy portfolio regardless of the investment income decision that's being treated separately. So it should not have any impact on our future pricing.
All right, we'll take the next question from Waruna Kumarage. Please go ahead.
Hello, good afternoon. Am I audible?
Yes, you are. Please go ahead.
Yeah. Thank you, Elena. Thank you, gentlemen. I have a couple of questions. The first one is related to the comment on the impact of concentration on the high unit cost provider, which I think this is I mean, correct me if I'm wrong, this is the first time we are discussing this in your conference call. So I was wondering, like, when it comes to factoring that into your pricing, is it reasonable to expect that it will take some time until you are able to price it into all your contracts, because the contracts are signed throughout the year, so that you will have this impact for some time? That's my first question. Second question is related to the treatment without pre-approval. Now you said you have 17 providers and increasing to 20 by year end. I mean, have you seen? I mean, have you experienced this has an impact on the overall claiming behavior? Because now patients are going for certain maybe medication or even tests without pre-approval. I mean, is that a factor? Just maybe I'm wrong, but I just want to get your thoughts on that. Thank you very much.
Very good questions, Aruna. Let me start with the first one on pricing. That is already in effect, and it's been in effect. But to see the impact of it, you will need time, because the businesses that have been written, including in quarter two, already assume that level of inflation and the concentration risk we are seeing. But for that to be earned and materialize, it will take time. But in terms of, I believe your question was related to our ability to execute on that, and that's already on effect. But the earning part would come in the future. And regarding your second point, actually the providers we announced with no pre-auth are behaving the inflation is much lower, and that's the whole point of having no pre-auth at those providers. The concentration we are seeing is related to other providers and actually driven by upgrades of products to the higher end. When you look at the construction of the book overall, it has higher concentration at those providers, but the ones with no pre-auth are actually behaving better than the average of the book.
Okay, that's clear, Hatim. Just one follow-up. If I look at your medical inflation chart compared to last quarter, your base inflation has increased from around 6% to 8%. So this is the impact of this high unit cost provider, right? Am I correct?
Yes, yes.
Okay, that's clear. Thank you very much.
No problem.
We will take the next question now from Abdulaziz Al-Qadi. Please go ahead.
Yes, thank you, management. This is Abdul Ghali from Riyadh Capital. Just a question from my side. So regarding the loss ratio, so we've noticed that the SME's loss ratio rose to 85% from 73% in quarter-on-quarter basis, which is a way larger move than the corporate, which is 97 from 92%. So just could you explain the reason behind that? Was it like coming from a low base in the first quarter for SME? And secondly, maybe it's partially answered, but it's should we take the second quarter as a benchmark in terms of loss ratio for the rest of the year, or you rather not comment on that? Thank you.
Sorry, can you repeat the second part of Aziz?
Yeah, I was talking about the loss ratio. Should we take the second quarter as like a benchmark for the next two quarters, the next half of the year, or you rather not comment on that? Thank you.
No, and on your first point is related to SME.
Yeah, the SME loss ratio has expanded from 73% to 85% in the quarter in Q&Q basis, comparing to the corporate. So I'm just asking, could you explain the reason behind SMEs expanding higher than the corporate in the second half?
Okay, good. So let me just clear the first question first, as it's related to the previous comments. So in the currently, if you look at our net insurance results margin, you would see that we are actually at a higher base. So and we do believe that there is a room for us to improve and go back to the normal trend we had historically over the past 2 years. So that's what we are aiming for going forward into quarter 3 and 4. And as I mentioned earlier, the measures to get there are already in place. But that takes time for the written premium to be earned, right? So, but we are aiming to go back to that level. Now, on your first point on SME, it's actually a similar trend to what we mentioned overall, but you have higher impact on the SME book, given the growth that took place as well during that period. But there is no difference in the trend we are seeing versus corporate, yet the impact is bigger, but the reasoning is exactly the same.
Clear.
Thank you, Aziz.
We will take the next question now from Izul Molob. Please go ahead.
Hello. Hi. Assalamu alaikum. I just have one question. I know that just now you mentioned that relating to the Bupa Connect, that it's the aspiration is to provide like a better health outcome and also better member experience. But in terms of the operating expense, could you provide some kind of colors on how this will impact your claim side and also what kind of additional operating expense from running these flagship clinics?
Yeah, so let me just shed some lights on the model. So we are actually going with an asset light model where the majority of our engagement is already happening digitally. We have been in operation over the past year and a half, engaging with our members and trying to influence their health outcome through either directly or through different partners. Now, yes, you should expect a level of investment in that model. However, it's a much leaner model versus a brick and mortar model where it's all about expanding into different geographies and different cities. But the approach we are going with, as Med mentioned, is complementary to the already existing model we have digitally. So it would be very selective in very selective specialties, very selective areas where we would need a further intervention for our members. Yeah, that's what you should expect in terms of investment in building that ecosystem.
Okay, thank you.
We'll take the next question from Ankur Agarwal. Please go ahead.
From my end. So my first question is that have you been able to reprice some of this inflation or additional inflation that you cite because of the concentration in favor of the more expensive providers in the second quarter? And should we expect more of that in terms of pricing in the coming quarters? So that's my first question. My second question is regarding the onerous contracts again. So just trying to understand, right? Last year also, third quarter, you had an onerous contract. By the fourth quarter, it was reversed back. So you did mention that you're being a bit more extra prudent right now. So how should we think about this onerous contract thing, which actually increased in the second quarter versus the first quarter? And I think one final question, in terms of ramping up Care Connect, were there any costs in the first half and the second quarter, which should fade away as the ramp up is completed, right? So any costs that are coming through the P&L as you ramp up Care Connect. So those are the three questions. Sorry, instead of two, we add three.
Sure. Hi, Ankur. So let me start with the first question. To your point, I think not only Bupa, but the whole market has been reacting in quarter two to the higher inflation, and we do see that not only from Bupa but from all the players in the market, and that's a positive sign on the trajectory going forward. So to answer your question, yes, we've been able to do that, and competition have been able to do that, and as long as the market acts rationally and reacts to that inflationary pressure, then hopefully the entire sector would correct going forward. And regarding the onerous contract, let me reiterate the point. Now, I mean, if you go back to 2020, 2021 onward, actually between those 2 years, you would see a similar trend, but at that point in time, we did not have the IFRS 17 standards, but you would see inflation going ahead of pricing for a couple of quarters and then correcting. Now, in this situation, with that inflation coming in, the projection going forward, with the prudency we are applying to our book, mandate us to ride to record those onerous contracts. But as I mentioned, if the corrective actions materialize, you should see that improve in the coming periods. But at this point in time, we do see that curve of inflation going ahead, which mandates us to record the onerous contracts. Now, regarding Care Connect, it's actually it's been there since the beginning of 2024. So nothing new versus what we started since the beginning of 2024. Yes, there is a small element of the clinic Med mentioned, but these are very small in terms of expenses compared to our overall book. So it's not significant as we go with an asset light model where these are minor investment compared to the overall book and the overall expense level we have for Bupa Arabi.
All right, many thanks. Thank you.
No problem. Thank you.
We will take the next question from Karim Kehia. Please go ahead. Karim, please unmute your microphone. Karim, your line is on. Please go ahead.
No, or is this not audible?
We can hear you. Yes, go ahead.
We can hear you now.
Thank you. Apologies for that. Just a very quick question. Last year, I mean, looking at the sector last year in Q4, Bupa Arabia was honestly the only company to be onboarding additional provisions to their claims, while the rest of your competitors did not follow a similar trend, let me put it this way. And the previously stated 8.2% claims inflation that you had put out at the beginning of the year was somewhat communicated as overstated by also your competitors. And as such, I'm only asking this because we saw a more aggressive approach in terms of market share grabs by your competitors in the sector, not just the largest competitor, but many others. Yet today we have seen the bulk of the sector basically bearing or paying the cost of that unsubstantiated growth through higher claims, and the bulk of them have dipped in the red. So my question here really is that when you're raising your claims outlook from 8.2 to 10.4, I think this year, due to what you said is a industry trend in which claimants are going to the higher cost providers. Do you, based on your expectations and what you're seeing in the sector today, do you believe your competitors have shared enough pain in which that this additional claiming or this additional claims outlook on inflation will be incorporated in their pricing as well, which will allow you to basically pass on this easier to your customers and improve your margins? Or do you expect a similar trend to what has been happening, in which they will see this as a market share opportunity, and you as Bupa, being focused on your margins, may expect to continue to lose some market share in the short term up until the market adjusts? And the second question is maybe to Ali Schneemer, that is, it's okay, is that I'm just a bit surprised, and maybe you're not, by the increase in expat employees this year, the job market, as you mentioned. Is that due to Vision 2030 projects? Because based on our understanding that those projects, most of them have still been delayed, and they should be driving in a higher number of employees and so forth. Any reasoning why this strong job growth this year? And also, previously you had stated, I mean, I know it's not in your hands, but previously you have stated that GOSI and the Insurance Authority have now aligned the systems in order to incorporate the higher enforcement rates amongst Saudis and expats that are non-insured. And this was meant to be happening in Q2 of this year, if I wasn't mistaken. So is this not completely is it not being talked about, completely deferred for a later point in time? Or is it simply a matter of still continued alignments of systems that could happen, in your opinion, this year? Thank you.
Thank you, Karim. Allow me to take the first one, and then I'll move to Ali. Look, I can't. I hope the market reacts to that pressure in a timely manner for the sector to correct overall. But honestly, we have been in this cycle before a couple of times, and the trend has been corrected a couple of times. And I just mentioned earlier in the call in 2021 when the deferred claims from COVID took place, and everyone started correcting. So we are hopeful that there will be a correction, but from our end, we are focused on protecting the margin, and we will continue doing that. And as I mentioned to you earlier, I would say I'm cautiously optimistic, given what we saw in Q2, that the market would follow, given the pain that is already everyone is trying to correct their book performance. There is pressure for the rest of the market from the motor sector as well. There is an expected pressure coming from a reduction in interest rates, which would put pressure on investment income. So I really hope the sector overall would try to adjust and correct to enhance the sector's overall result.
Clear, thanks.
No problem.
Ali, maybe for the second part?
On the job growth, I mean, when I talk about job creation in the market, it's not just the giga projects. And giga projects, there are still, I mean, there are construction sites and there are workers in there. If they have scaled down some of these projects, doesn't mean there are no people actually going into the current phase. But also in the private sector, the real estate alone, the boom we have seen in Riyadh has a very high magnitude on most of the blue collar workers joining that sector and coming in to Saudi. So giga projects, the news that we hear about some scaling down, delaying, etc., doesn't mean that people have been sent out. It just they want to go into phases for these projects. On the alignment of the government systems, look, I mean, government authorities, they have different priorities. Insurance authority, we understand they have the national insurance strategy to be approved and published, and then they have a set of laws and regulations to be developed, drafted, and then approved. Probably you have seen the first draft of the regulation issued for public opinion a few weeks ago by insurance authority. Probably this is the top priority for us to close the gap. It might not be the top priority for regulators. We continue to actually talk about this, and we continue to discuss this topic with regulators in every venue to keep it a focus point for them. But I mean, that's all what we can do. Again, on the comment or the question that you asked, Hatem, if you look at the sector health only, the entire sector, Q and Q, if I look at the net underwriting results divided by the revenues, they deteriorated only by 0.3% Q on Q. If you look at the top players, their loss ratio have deteriorated by a couple of points, which again echoes the message that Hatem was alluding to, that the top providers, based on the mix of your book, top providers, higher unit cost providers, have actually contributed to the inflation in the market. The lower end of the market, actually, their deterioration was insignificant compared to the top players. And add to it also the huge expansion that we have seen as a sector in the XPRO book. XPRO is the unified contract for health insurance for government-linked entities, whether authorities or government-linked companies. That book has also become significant in the market. And by the way, they have no pre-auth clause in these contracts, unlike the rest of the policies drafted in the market. And this is unified. So whether we take the account with Bupa or it goes to another company, still these terms apply. And when you have no restriction on pre-authorization, and you have easy access to the top providers, as a member, why not? What would stop you? Why would you go somewhere else? So all these factors have actually contributed to the inflation that we have seen in the market. And by the way, if you look at the 9 TASI listed providers, 70% of their revenues is coming from insurance. And these are public information shared in their webcast, and you can track that. And I remember SMB issued a coverage recently where they detailed the percentage of revenues coming from insurance for all listed providers. And you join their webcast, and no one would want to decrease their business. So they want to continue.
Sorry, Ali, where is that? You're saying we can track it?
What?
You're saying we can track that? How can we do so? The
I mean,
percentage.
in their webcast, they share the split of their business coming from insurance. And I have come across a coverage report by SMB published recently for one of the providers, and they have actually the percentage of revenue coming from insurance for all listed providers. So 70% collectively of the revenues come from insurance. Definitely, if they want to grow their business, they will have to grow that from insurance. That's the biggest line of the business they have. So these are the dynamics in the market at the end of the day, especially with the phenomena of having more providers becoming listed, which puts them under pressure in front of their investors to continue growing. So these are the dynamics. All of them are contributing to the inflation we see. And there are different tactics, whether having better deals with providers, us expanding the no pre-authorization network of providers where we align on the protocols to be followed, and they have been actually behaving on that, or also making clients aware of their consumption or utilization trends that's taking place. Because at the end of the day, this will be paid by the customer eventually. No insurance company with a RAS1 competition intentionally wants to write a loss-making business. So this will be eventually pushed to the customer, and that's why we are making them aware of their utilization trends, where their policy is being consumed, who are the top providers in terms of utilization, what are the conditions they go to, et cetera, et cetera. This is a three-party relationship between the insurer, provider, and the customer, where we need to align incentives for us to continue progressing in this market. Sorry for the long answer, Karim.
Black's very clear. Thank you so much for that.
All right, we have time for last question. We'll take them from Talal Al-Radan. Please go ahead. Talal, you can unmute your microphone. All right, I think Talal may have issues with the microphone. We'll take a last question from Madhu Apisa. Please go ahead.
Thank you, Ellen. I'm Madhu Apisa from Alraji Capital. Two questions. One on the no pre-authorization initiative. Just wanted to understand what is in for you and the hospitals, because you mentioned that 17 hospitals are part of this initiative, which is more than 10% of the total private hospitals in the kingdom. Despite that, your loss ratios went up and you have increased your base inflation to 8% from 6%. Now, just wanted to understand, were there any negotiations on pricing? Because the loss ratios do not indicate that. If not pricing, were there any negotiations on payment terms? Because we have seen substantial increase in receivables for all the listed hospitals, almost 30% sequential. And in your case as well, the claims paid versus the claims incurred, there was a difference of almost $1 billion. So if you can provide clarity on how this initiative is benefiting you, that would be helpful. Second, on the base inflation, uh, hospitals talk about reducing rejection rates, or some of the hospitals are also in negotiation for price hikes. So does that have any impact on your decision to increase the base inflation? And let's take a scenario that it does, the competition does not reduce, and you're not able to increase the pricing to match the medical inflation. Is there any other way that you can control your claims? For example, like uh, adjusting the network of hospitals that are, causing this medical inflation? These are my two questions.
Thank Margaret. Sorry, can you repeat your second question? I'm not sure I got it.
Yeah, so second question is on base inflation of your decision to increase the base inflation forecast for 2025 to 8% from 6, which is a substantial jump. And I believe this 8% inflation expectations is the highest in last perhaps 7 years or 8 years. Now, you mentioned that, this is mainly because people are shifting to high unit cost providers. But when we talk to hospitals, they talk about their focus on reducing rejection rates or increasing their prices for insurance. So does that have any impact, like
I got
hospitals'
Yeah, yeah,
decisions to lower rejection rates or their move to increase the prices? Is that also impacting your base inflation expectation?
I got
And
that.
the
Go ahead.
Yeah, and the follow-up to that, but let's take a scenario that, the situation is not conducive for you to, pass on the cost. Would you be focusing on alternative ways of managing the inflation by, removing some of the hospitals which are part of the network, which are adding to your inflation?
Sure. Good. So let me start by the first point regarding the no pre-authorization impact. Madhu, you are linking one initiative to the entire trend of the sector. So I think it's a, it's not the only factor that is taking place. So yes, there is an initiative that started on a no pre-auth for different providers. By the way, it started from last year and helped us improve the experience and improve the cost last year. This year, as we mentioned, there has been a different trend and different trajectory impacting us. It has nothing to do with the no pre-auth initiative, which started since 2024. So it's not one-to-one. It's not one factor affecting the entire result and the entire trend of the sector overall. On your second point on the providers reducing the rejection rate or increasing the price, this is, I mean, every year we go into. Sorry. So every year you go into the year with a certain expectation of price increase or adjustments from providers, depending on contractual agreements that are usually longer term and doesn't change every year. And that's business as usual for us. It's not something. It's not a surprise. But because these things and these changes doesn't happen overnight, it takes time to change those debts. However, the trend and the concentration is the new trend we've been witnessing. But to your point, has the price increases from providers contributed to that? It always contributes to inflation, but it's already accounted for. It wasn't something that was not accounted for. The members' behavior of moving to higher unit cost providers is the extra element that came on top. And sorry, the last part of your question, I forgot to address that on. Definitely, there are multiple efforts to control cost related to product interventions, claims optimization, and control that are always taking place. As I mentioned during the presentation, we are aiming to improve the margin and take it back to the historical trends we've had. So there are multiple efforts that are in place, and it's already action, but it takes time to have that impact on the financials, and we are monitoring that to improve it in the coming quarters.
All right, I think due to time constraints, we will end the call here. I would like to thank the management team for their time.